All right, so before we bring in Dr. Yun, we're going to introduce him and kind of read and tell you guys about who he is. Most of you all know who he is, but before we bring him on, I want to give him a proper introduction. So Lawrence Yun is Chief Economist and Senior Vice President of Research at the National Association of Realtors. He oversees and is responsible for a wide range of research activities for the association, including NAR's existing home sales statistics, Affordability Index, and home buyers and sellers profile reports. He regularly provides commentary on real estate market trends for its 1.4 million realtors. Dr. Yun creates NAR's forecasts and participates in many economic forecasting panels, among them the Blue Chip Council and the Wall Street Journal Forecasting Survey. He appears regularly on financial news outlets, is a frequent speaker at real estate conferences throughout the United States, and has testified before Congress. He also participates in the Industrial Economists Discussion Group at the Joint Center for Housing Studies of Harvard University. He has appeared as a guest on C-SPAN's Washington Journal. Dr. Yun received his undergraduate degree from Purdue University and earned his PhD from the University of Maryland at College Park. What an amazing resume he has. He is full of knowledge, and I would love to welcome Dr. Lawrence Yun into the show right now. Thank you, sir. Thank you for joining us.
Good morning, Adam and Jane, and hello, Kentucky. So very good. In regards to the housing sector, one of the very few sectors that thrived during the very difficult year of 2020 pandemic, the job losses across the economy, certainly a year to remember and share with our grandkids 50 years from now about what happened in 2020. But the housing market not only held on, but actually boomed. Now we are in early months of 2021. So what can we anticipate? Is it a continuing positive momentum, or maybe things begin to top out and begin to retreat? So what is in cards for 2021? Well, yes. Today there was a fresh data came out from the government regarding the job market and the good job addition, but also the little alerting information, which is that mortgage rate will inevitably rise because fiscal stimulus, $1.9 trillion, that is being discussed in the Senate, likely to pass, which means that there will be additional income for many Americans, $1,400 additional per person. Very good news on that regard. But as we know, it's not free lunch. So larger budget deficit, larger national debt, financed by printing of the money. It just means that the borrowing cost by the government is rising, and that generally pushes up the mortgage rate. Let me share with you a few slides to just give you some flavor of how the market will play out. So bear with me as I upload some slide onto the screen. So hold one second. So there we are. So this is the overall job market situation in the US. And what is interesting about this chart is that first, that little hump that you see rise and decline back in 05 to 2010, that was due to the housing market crash. So one natural question that people ask is, given the heated housing market, should we prepare for any potential crash? Is it a bubble? And I say absolutely not, because the backdrop is fundamentally different. We don't have those funny mortgages that overstretch people's budget, or without checking income documentation as occurred 10, 15 years ago. We have a sound, underwritten mortgage criteria today. So that's one big difference. And the second part is, back 10 years ago, we had an oversupply of homes sitting on the market for 6 months, 8 months, 12 months on the market, price reduction, foreclosures. Today, as you know, homes come on the market, and about half of the homes contract is signed within 30 days, not enough inventory. So that's a major difference. And if you look at the second half of this chart, it shows that amazing job growth right up to the pre-pandemic. Then the lockdown occurred, and we lost 10 years of progress in a single month. Single month lost 10 years of job creation. Now, as the economy reopened, you see some job growth occurring, but we are still far from getting back up to normal. Let me just say, here's the Kentucky market. Look very similar to the U.S. So you see the 10 years ago little fluctuation, foreclosure crisis, 10 straight years of job creation, lockdown.
I apologize to interrupt, but the slide is stuck on the cover there for us.
Okay, so somehow let me then do this. I think there is a second method of uploading. So thank you for informing me of that. So let me try the second method. Okay, so this is Kentucky. So this is Kentucky, and you see a very similar pattern as to the U.S. So during the lockdown, you see massive job losses, but now trying to climb back up again. Interesting regarding the state-by-state comparison. So you see where Kentucky lies, minus 5.2% in terms of job from pre-pandemic to current. But if you look at, say, Tennessee is down more modestly, or generally the southern states are down much more modestly, while the northern states like Wisconsin, Michigan, New York, they're down much more significantly. And one difference as to why this occurs is related to governor's policy. In the states that was more restrictive in terms of a lockdown and slow to reopen, they have a harsher job losses, like state of New York. While southern states, they're essentially saying it's dangerous out there, but we will not shut the economy down, put on the mask, follow social distancing. So a little variation, but Kentucky, about national average in terms of down 5.2%. One unique aspect of this recession is that this is the first recession in American history where economy is down, which is the first column, GDP is down. But if you look at the right-hand column, average personal income is up from 1 year ago. First recession where ordinary American actually have more income than before. All the stimulus check, the first round, the second round, now the new one, I think that will soon be passed. All this is coming, small business loans, enhanced unemployment benefits. So average American have more income during a recession than before the recession. On average, we know some families on going to the food bank, struggling through their rent payments. So we know of those cases. But the first recession ever where average Americans have more income. What are people doing with this extra income? They're not spending it. They're saving it up. So savings rates are very high, and all the major banks will say their bank deposit is rising and rising, which just means that once we reach the herd immunity, and medical experts believe that it could be in autumn of this year. And let's hope that's the case because we want a return to normal life. So if that is the case, people can go see, say, the football games in person. We can do indoor dining and travel. All that unleashing of this savings back into the economy. So the second half of the economy looks very bright. The first half is really trying to get that stimulus impact into the economy. Quickly, home sales, as you know, made a sharp U-turn. So home sales not only recovered, but it went beyond the pre-pandemic levels, quite special in terms of how people are viewing. And this is the interesting take. If you look at where the sales are rising, it's on the upper price range, while the lower price range, sales are barely rising, or in fact, at the very low end, are actually declining. So why? Well, on the upper end, people want larger size home. Working from home for office workers has completely changed the dynamics. But on the lower end, it's not due to the lack of demand. We simply don't have enough inventory. So if we had more inventory, then we can get more sales clicking on the lower end. This is a national data, and I understand Kentucky is more affordable, which is actually a good trend because you may begin to see some people from Chicago selling their home and moving into more affordable regions in Indiana, Kentucky, people from New York going into Tennessee. So that trend may begin to occur as work from home possibilities greatly increase during this situation where now many office workers are able to work from home. So what is the prospect of getting more inventory in 2021? And answer is, I think we are turning the corner, but it's going to take a few months because single family housing starts, which is the blue line, is beginning to ramp up. The housing permit data is showing consistent increase. So you first get a permit documentation, then you start digging, and then you start completing the home. So those completion of homes should begin to show up late spring, early summer. So the inventory situation will get better, but it may still require 2 or 3 years to get truly balanced market. It's been seller's market, maybe less heated condition later part of this year, but balanced market only like 2 or 3 years from now. And the likely path for home sales in 2021 is the following. All the data is indicating that in the first quarter, sales would be up about 20% from 1 year before. Second quarter, it will be up 50%. And now you have to shake your head and say, no way possible. Then you have to remember, second quarter of last year was a lockdown. So we had an artificial low base period. So we are growing from that low base. Third quarter, no meaningful change. Fourth quarter, actually slightly under compared to the fourth quarter of last year. So if you believe that this makes a reasonable sense, there's some logic behind it, then what you get for the annual is that in 2021, total home sales would be about 15% above last year. So very good backdrop for business opportunity. And let's hope that the mortgage rates, which is one concern, still remain affordable. So let me wrap it up with this final chart. Mortgage rate, the red line is beginning to rise. I already have incorporated or assuming that mortgage rate will reach 3.3% by year end. So if that's the case, it will not be a major concern. The market can handle it. But if it rises above, say, reach close to 4%, then it will be an alarm bell. So why is the mortgage rate rising? It's because the blue line is rising. And why is the blue line rising? As mentioned, all the stimulus measure, it is not a free lunch. Higher national debt, more borrowing, that is pushing up the blue line borrowing costs. And when the blue line goes up, inevitably the red line goes up. So higher mortgage rate will be something of a headwind, but the tailwind is job creation that will be coming because of stimulus. And the second half of the year, the vaccination and getting back to normal life. So thank you for providing me with some opportunity to share some thoughts on this. But again, for real estate professional, a great backdrop in 2021.
Yeah, that's great. That was really good information. It's very interesting to see what's going to happen in the second quarter of 2021. That's enlightening. So, and in the fourth quarter, kind of below what we are now a little bit. So that's some good knowledge to have. One of the biggest questions we are asked, how's the market? I think we're not asked nearly as that question as much as you are. So I appreciate you coming on and updating us a little bit about that.
Yeah, my pleasure. And I think, one of the benefit of Kentucky is, again, that work from home phenomena. Before the pandemic, only 5% of the workers were working from home. During the pandemic, office workers, due to it, about 1/4 are working from home. And it is very doubtful, even with vaccination, that the CEOs will say, come to office 5 days a week. I think it's going to be some kind of hybrid. So one can easily envision, come to work 3 days a week, but Monday and Fridays, you can work from home. So long weekend. And people say, why don't I have a second home out in Kentucky? So people may begin to say that. So you may get an additional boost in housing demand from this new economy of working from home.
Oh, that's good. And, one of the things we've kind of been observing too is even the design of homes going into this new have begun to change. I mean, that Zoom room, if you will, everybody's needing the Zoom room, homeschooling rooms, so we're starting to see building trends change. Do you feel like building costs are going to kind of come down a little bit throughout this process? Is that going to help us increase inventory?
So one major challenge that the home builders are facing is that lumber prices and other material cost prices, which have been rising due to the strength of the housing demand, but also because of some of the tariffs. Now, to the degree possible, we as an Americans want to help our fellow Americans. But if we put tariffs on foreign products, specifically lumber tariffs on Canadians, so if we eliminate the tariffs on Canadian lumber, then the lumber prices will be lower, more home building in Kentucky, more job creation in Kentucky, which means more listing on MLSs and more business to be done. So in some cases, trying to bring imported product can actually help job creation in the U.S.
Okay, yeah, that's good. I really hope that's what happens, because we definitely need more homes. So on the investment side, real quick, and just one more question, and we can let you go, is on the investment side. If you're an investor looking at properties, you got commercial, industrial, and residential. As an investor that's looking to invest in properties, which would be a more viable option given the state of this new work from home and all this kind of stuff? Do you see the commercial sector getting hit a little bit on that side of it, or not?
The major city, expensive city downtown is going to be very tough. So whether New York City, Chicago, San Francisco, they will be reducing the price on those properties as well as the rents. However, in the suburbs, some of those office satellite spaces, I think the demand will be there. And furthermore, for people who want to invest, maybe they can sniff out some bargains on those commercial properties because prices are coming down. Completely opposite compared to housing. Home prices are rising, but the commercial real estate prices are coming down. So that could be some opportunity. And for people who are buying just another home to find the renters, consider the fact that we are still undersupplied. The rental demand initially fell off during the pandemic because many young adults just moved in with their parents during the time of uncertainty. But now with jobs recovery, I think the demand for rental housing will begin to pop out. So the real estate investment, just trying to buy that additional investment property, I think could work out well as well.
Okay, that's really good, really good. Just so you know, Steve Robinson, he is our principal broker owner of the company, and he said, Dr. Young, thank you so much for being on the show today. It's an honor, sir. Thank you for your insight today.
Thanks for having me, and for everyone, have a wonderful day and rest of the weekend.
Thank you as well. Thank you. Take care.